Asset prices do not move because stories sound exciting. They move because cash flow, liquidity, interest rates, and positioning keep repricing risk across time. If you want to invest like the rich really invest, stop asking what is hot and start asking what is being paid, what is being discounted, how liquid the market is, and how much damage you can survive if you are wrong. Look at how wealthy investors actually behave when real money is on the line. They do not begin with prediction. They begin with structure. They decide what percentage of capital is meant for liquidity, what percentage is meant for compounding, what percentage is meant for asymmetric opportunities, and what percentage must never be exposed to permanent loss. You should think the same way. Before you buy anything, know why it belongs in your portfolio, how long you expect to hold it, what would invalidate the position, and what part of your financial life that capital must still protect. The market is not a machine that rewards optimism. It is a pricing system that constantly converts expectations into valuation. That matters because you are never simply buying a good company, a bond, a house, or an index fund. You are buying an expected stream of future outcomes at a current price. Rich investors understand that distinction deeply. They do not confuse a strong asset with a strong entry. A wonderful business can be a bad investment at the wrong price. A weak-looking sector can become a great investment when the pricing already reflects too much fear. So here is the operating mechanism you need in your head. Prices are moved by a combination of earnings, expectations, discount rates, liquidity conditions, and positioning. Earnings expectations tell you what the market thinks the asset can produce. Discount rates tell you what future cash flow is worth today. Liquidity tells you how much money is available to chase risk assets. Positioning tells you whether too many people are already leaning the same way. When those four forces line up, trends can run much farther than logic alone would suggest. When they conflict, price action becomes unstable and narratives break fast. Now go one layer deeper, because this is where most retail investors stop too early. Every market has its own equivalent of a biological mechanism. In equities, price responds to revenue growth, margin quality, capital allocation, refinancing conditions, and multiple expansion or contraction. In bonds, duration, sensitivity, inflation expectations, and central bank path matter more than storytelling. In real estate, financing costs, vacancy risk, local supply, and rent durability matter more than flashy appreciation charts. In private businesses, customer concentration, working capital needs, competitive moat, and operator quality matter more than surface-level growth. Rich investors train themselves to see the drivers underneath the visible chart. Momentum matters because capital often follows relative strength before it follows full understanding. Cash flow matters because in the end, ownership is valuable only if it throws off distributable value or can reinvest at attractive rates. Interest rates matter because they change the present value of future returns and the attractiveness of safe alternatives. Liquidity matters because even strong assets can get repriced lower if credit tightens and forced sellers appear. Volatility matters because it changes your required position size, your psychological stability, and the likelihood that you will break your own rules. Positioning matters because once a trade becomes crowded, even good news may fail to move it higher. This is why most investors misunderstand the game. They treat investing like product shopping. They want a list of best assets, best sectors, best stocks, best opportunities. That is not how serious capital is managed. You should think in terms of regime, price, probability, and exposure. Ask yourself, are you in a liquidity-rich environment or a liquidity-starved one? Are rates falling, stable, or rising? Are margins expanding or being squeezed? Is this asset cheap because it is ignored or cheap because the business model is deteriorating? Is this asset expensive because it is high quality or expensive because the crowd is trapped in a single narrative? Rich investors also separate time horizons with discipline. Your liquidity reserve is not your opportunity fund. Your retirement compounding capital is not your tactical trading sleeve. Your long-duration wealth engine is not the same thing as your short-term speculation bucket. When you mix time frames, you sabotage judgment. You buy a long-term position, then panic at short-term volatility. Or you take a short-term trade, then turn it into a long-term hold, because admitting the trade failed feels painful. You need cleaner lines than that. Start by dividing your investing life into jobs. One pool of capital is sacred liquidity. This money is there so you never become a forced seller. One pool is long-term compounding capital. This goes into durable, broad, high-quality exposures where time does most of the work. One pool is selective, active capital. This is where you take more concentrated views when valuation timing and information signal line up. And one pool can be reserved for high-upside, asymmetric bets, but only if losing it would not damage your core plan. Wealthy investors preserve optionality first. They do not gamble from their foundation. Now let's turn this into action. When you study an asset, first define the time frame. If this is a multi-year compounding position you care most about, business quality, valuation, reinvestment, runway, balance sheet, strength, and management discipline. If this is a tactical trade, you care more about catalyst timing, liquidity, positioning, volatility, and where the crowd is likely wrong in the next defined window. If you do not define the time frame before entry, price movement will define your emotions after entry. Then, define position size before you define conviction out loud. This is where rich investors are colder than most people expect. They do not prove conviction with dramatic size. They express conviction through calibrated exposure. If volatility is high size, smaller. If the thesis depends on a macro outcome you cannot control, size, smaller. If the asset is illiquid, size, smaller. If the thesis is strong but timing is uncertain, start partial and add only when the market confirms the setup or valuation becomes clearly better. You are not paid for sounding certain. You are paid for surviving uncertainty. Here is the practical logic. If the market is in a broad uptrend, liquidity is supportive, rates are stable or falling, and earnings revisions are improving, you lean into risk gradually. You do not chase vertical moves, but you do allow quality assets to earn a larger share of capital. If the market moves up too quickly on expanding optimism, while valuation stretches and positioning gets crowded, you do not necessarily sell everything, but you tighten your standards. You reduce fresh entries. You scale into strength rather than buying impulsively. You ask whether the next buyer is likely smarter or just later. If the market breaks lower on fear, but credit conditions remain functional, forced selling looks temporary, and high-quality assets are trading below conservative estimates of value. You begin building exposure carefully. Not all at once. Rich investors rarely fire all capital on the first red day because they know drawdowns often unfold in stages. You buy in layers. You preserve cash for better prices. You let the market show you where panic becomes indiscriminate. If the market moves lower because rates are rising sharply, refinancing conditions are worsening, liquidity is draining, and earnings expectations are still too high, you become more defensive. You reduce cyclical exposure. You respect balance sheet risk. You favor quality and liquidity over narrative. You do not average down mechanically just because something is cheaper than it was last month. Price alone is not value. You want evidence that the mechanism underneath the price is stabilizing. Entry logic should be simple enough to execute under stress. You enter when three things align: the asset is attractive relative to your estimate of value. The operating mechanism is moving in your favor, or at least stabilizing, and the position size fits your risk budget. Exit logic should be equally clear. You reduce or exit when the thesis is invalidated, when valuation becomes far less attractive relative to forward return, when a better opportunity demands the capital, or when the original time frame has passed and the reason for ownership no longer exists. Do not invent new reasons to stay in a position after the old one stopped working. Risk limits are not a sign of fear. They are proof of professionalism. Decide in advance how much total portfolio drawdown you will tolerate, how much single position risk you will tolerate, and how correlated your positions are allowed to become. A portfolio of 10 different tickers can still be one bet if they all depend on the same macro condition. Wealthy investors look through labels and ask what really drives the portfolio. If growth stocks, private business exposure, real estate, and venture funds all depend on cheap capital, then rising rates can hit all of them together. Correlation hides in the background, until stress reveals it. This is where most people stop. But this is the advanced level. The advanced level is not more complexity for its own sake. It is seeing second-order effects before they become obvious. When rates rise, do not stop at stocks may fall. Ask which business models require refinancing soon, which sectors lose valuation support fastest, which consumers weaken. First, which credit spreads are underpricing stress, and which seemingly safe assets are only safe in a liquidity-rich regime. When inflation cools, do not stop at good for markets. Ask whether that cooling comes from stronger supply or weaker demand, because those lead to different winners. Mode change matters more than most investors realize. A market can shift from liquidity-driven to earnings-driven, from narrative-driven to balance sheet-driven, from momentum-led to mean reversion-led. If you are using yesterday's playbook in today's regime, you will look smart right until you look lost. This is why rich investors constantly update, but they do not constantly overtrade. They revise interpretation faster than they revise identity. The process stays steady. The inputs are what change. Correlation breakdown is another advanced concept you need. In normal conditions, diversification works quietly. In stress, correlations can suddenly move toward one. Assets that looked independent begin falling together because investors sell what they can, not only what they want to. That is why liquidity quality matters. You do not want a portfolio that feels diversified only in good weather. You want to know what happens when funding conditions tighten, when volatility spikes, and when buyers step back. Run that thought experiment before the market runs it for you. Then there are liquidity traps. An asset can be statistically cheap and still remain dangerous if the buyer base disappears, refinancing is blocked, or the business cannot bridge the gap to recovery. This is why rich investors care so much about time to survival. A good asset with no liquidity can become a bad outcome. Bankruptcy risk mathematics are unforgiving. A 70% drawdown requires a much larger rebound than most people intuitively feel. Permanent impairment is not just a larger temporary loss. It is the destruction of compounding itself. Avoiding that outcome matters more than catching every upside burst. Behavioral traps sit on top of all of this. Overconfidence shows up when a few good outcomes make you think you understand a system you barely sampled. Trend chasing shows up when you confuse movement with safety. Poor risk control shows up when you increase size because a trade already moved your way. Ignoring timeframes shows up when you treat every red candle as a betrayal or every green candle as confirmation of genius. You need to be harder on your process than on your ego. So how do you practice this like a serious investor rather than a content consumer? Start journaling every decision before you place it. Write the asset, the time frame, the thesis, the risk, the invalidation point, the expected driver, and the reason this idea deserves capital over your next best alternative. Then after the outcome review, not only whether you made money, but whether the reasoning was sound. A profitable mistake is still a mistake. An unprofitable decision made with strong logic can still be a good trade. Use reverse testing. Take a position that worked and ask how it could have failed. Take one that failed and ask under what conditions it would have worked. This trains you to think in scenarios, not slogans. Run simulations on paper or in a virtual account when you are learning a new strategy. Then move to small-scale execution. A tiny, real position teaches you more about your behavior than a perfect spreadsheet ever will because real money activates real psychology. Build a checklist you actually respect. Before entry, confirm. Market regime, liquidity, backdrop, valuation, position, size, correlation impact, and exit logic. Before adding, ask whether the thesis improved or your emotions got louder. Before selling, ask whether the thesis is broken or you are simply uncomfortable. Measure your hit rate. Average, gain average loss time, held thesis accuracy, and rule violations. Evaluation loops matter because investing is not only about finding opportunities. It is about becoming the kind of operator who can process information without self-sabotage and combine tools. Valuation without macro awareness can leave you early or trap you in value illusions. Macroeconomics without technical timing can make you directionally right and financially wrong. Technical analysis without risk management is just pattern worship. Risk management without conviction can leave you permanently underexposed. Rich investors do not worship one framework. They layer them. They ask what the asset is worth, what the macro regime supports, what price action is signaling, and how much risk the portfolio can carry if the analysis is wrong. Under pressure, reduce size before you reduce standards. Use virtual trading for new tactics. Use small-scale trading for behavior testing, and run pre-trade stress analysis on every material position. Ask what happens if the asset drops 20%, if liquidity disappears, if rates move against you, if earnings miss, if the market closes, risk appetite for 6 months. You do not need perfect foresight. You need prepared flexibility. That is how the rich really invest. Not by chasing secrets, but by building a system where valuation, liquidity, time horizon, and risk all have a job. Read the first line of this script again after you place your next trade, because the order of those forces is not accidental.